Okay, let's go.
Welcome to The Explainer. Today, we're going to strip the charts back to their naked form. We're breaking down 5 core rules for price action trading to help you understand what the market is really doing moment by moment. But first, let's kick things off with a big question. It's one that has probably crossed the mind of anyone who's ever stared at their trading account after a rough week. Why is it that so many people who get into trading really struggle to find any consistent success? Well, according to our source material, the problem often starts right here. It's this search for some kind of magic bullet, a perfect indicator or a totally hands-off system that promises to do all the heavy lifting for you. But this usually turns out to be a dead end. And that very search leads directly into what we can call the indicator illusion, this weird situation where the exact tools that are supposed to help you can actually end up holding you back. So let's just break this down. On the one hand, you have indicators. They're always looking in the rearview mirror. They're telling you what has already happened. And this can seriously clutter up your chart and just create a ton of distraction. But on the other hand, you've got naked price action. And that's all about the now. It strips away all the noise to show you what the market's true movement is, which lets you actually understand what's going on. Okay, so if we just go ahead and strip away all those indicators, what are we actually looking at? What are we left with? And maybe more importantly, how in the world do we even begin to read it? And here is the absolute core idea. Price movement isn't just random static on a screen. No, it's a direct reflection of human psychology, that constant battle between greed and fear, playing out in real time. And because human behavior tends to follow predictable patterns, guess what? So does the market. All right, with that in mind, let's move on to our first set of rules, and these are all about understanding the market's direction, or what we call its trend. Now, this first rule is so important, because it goes against a very common gut reaction, especially for beginners. When you see a trend line break, your first thought is probably, that's it, the trend is over. But that's usually not the case, at least not yet. This slide just illustrates that trap perfectly. The common mistake is to jump on what you think is a reversal the second a trend line breaks. The price action rule, though, it teaches patience. It tells you to wait, to actually expect one final push from that original trend. Just understanding this one thing can save you from a ton of failed trades. And this quote highlights a fundamental truth about the market, which brings us right to our second rule. You have to resist temptation. Markets are often designed to make the completely wrong decision feel like the right one. Look, the bottom line is this. Trying to fight the trend is like trying to swim upriver against a really strong current. Yeah, you might make a little bit of progress, but eventually you're just going to get exhausted and swept away. Trying to pick the exact top or the exact bottom of a move is a game where the odds are massively stacked against you. Okay, so we know what to do when the market is trending, but what about when it isn't going up or down? What about when it's just moving sideways, stuck in what we call a trading range? This right here is probably the single most powerful concept you need to get for these kinds of sideways markets. While so many traders get all excited by the momentum of a breakout, the reality is that the vast majority of them just fizzle out, and then they reverse right back into the range. So this slide lays out the strategy perfectly. Instead of chasing those breakouts like everybody else, you do the opposite. You fade them, which is just a fancy way of saying you trade against them. You identify the ceiling and the floor of that range, and your goal is to sell when the price gets expensive near the top and buy when it gets cheap down near the bottom. All right, so now we've covered the 2 main market structures, trends and ranges. Let's get a bit more granular and talk about the rules that help us pinpoint the exact moment to actually enter a trade. This one is all about discipline. It's not about jumping into a trade whenever you feel like it. No, it's about having a very strict checklist and waiting patiently for the market to give you a very specific pattern, one that has a high likelihood of actually working out. Now, the key is you need all 3 of these ingredients to line up at the same time. First, what's called a second entry. See, markets often pull back in 2 distinct waves or legs. Waiting for that second leg gives you a much more reliable entry. Second, this whole pattern has to happen at a key area on your chart, like a trend line. And then finally, you need one last piece of confirmation. And that confirmation is rule number 5, the signal bar. Just look at the difference on this slide.
A good signal bar is strong, it's decisive, it closes with real momentum in the direction you want to go. A bad one, it's small, it's weak, it shows total indecision. The candle itself has to basically scream yes to your trade idea.
So let's put this all together. Think of this as your mental checklist to run through before every single trade. It forces you to apply all 5 rules we just talked about, from figuring out the market structure all the way down to confirming your entry. This is really how you start trading with intention, not on impulse.
And that leaves us with one final question to think about. Because the real goal here isn't to just blindly follow a bunch of rules. It's to learn the actual language of the market. It's to stop listening to the echo of past data from all your indicators and to start reading the story the price is telling you, right here, right now.